Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
Welcome back to the Vancouver Commercial Real Estate Podcast. And I'm your host, Cory Wright.
This is James Bond related, I think.
Yeah, this is...
I
was like, who?
Yeah. And I'm your sometimes host, Matt Scalina. I just had friends. We were just talking about James Bond.
Yeah.
And full disclosure, we did basically a 5-minute segment for an introduction that I failed to press record on the
Well, I was going to say, when you
recording
said
device.
just talking about it, I was literally going to say, we just talked about it for 5 minutes and then we realized the record button wasn't
there's
hit
going to
yet,
be a lot
so-
of references during this introduction that no one else is going to understand because it's the second one of the day.
Well, I'll be honest with you. That was our best intro we've ever done
I
so
feel
far.
like we
We're
hit the
not gonna be
cover
able
off
to
the
ever-
ball on that one.
We're never ever going to be able to beat that.
That is true. But first off, Cory, let's get to our guest. It's Matthew Dunnigan, commercial mortgage specialist from Impact Commercial. The exciting thing about having Matthew on is he's talking about how to invest, specifically buying commercial real estate as an investment property.
Yeah, we had lots of listeners reach out to us. Hopefully a lot of listeners know we kicked off this whole thing months and months ago when we had Al from Impact on that
That's right.
just talked about here's how commercial lending works just on the Coles Notes version of it.
Broad strokes.
We had John who came in and talked from Impact, who came in and talked about owner occupiers. And this is how you as a business owner potentially can be your own landlord. We had a lot of investors reach out and say, hey, I need to know more about the investing criteria. How does that work? So we reached out to Matt, said, we need you to come on. We need to break this down. And he doesn't disappoint.
No, he doesn't disappoint at all. And the thing that I always get asked, because we work with a ton of residential real estate investors, when they ask me about commercial, it's like everyone has trouble wrapping their head around how you don't have to go full open kimono the way you do in residential real estate, where they're looking back about some expense from 2003.
Yeah.
And it's not that way in commercial, which is so exciting for investors.
Well, it's funny because on last week's episode, we had Pete Leung on, the investorpreneur, and he was talking all about the challenges you have when you're trying to maybe buy multiple residential investment properties versus commercial. And in residential, they look at like, hey, can Cory afford that? How much does Cory make? And Pete last week referred to it, and Matt dives into it a lot this week. They look at the lease. That is the single most important thing. Who is the tenant? How much are they paying? How long are they there? That seems to be the big benchmark from a criteria standpoint that lenders will look at versus in residential, they're looking more at you as a personal indemnifier of that lease. And can you afford to make it regardless to maybe what that rent has out of the gate?
Whether it's vacant or not, right?
Yeah.
Yeah, no, that is a very exciting component to today's talk and an exciting component of the commercial real estate world more generally.
Yeah, it's just more fun on this side of the fence. That's why I try to get you guys to come play on this side of the fence, but you guys keep going back over there.
I am flattered. Thank you. I don't even know what to say. But before we get to our talk with Matthew Dunnigan, Cory, two things. One, Succession has started again. I feel like I have to mention it. This show is the best thing since Sopranos. And maybe The Wire. This thing Succession is that good. If you're not watching it, you're making a huge mistake.
Well, I'm not going to lie to you. When it first came out, I got about 5 or 6 episodes into it. For whatever reason, it just wasn't clicking for me.
I heard that from somebody yesterday, actually, that he said he's watched the first 3 episodes twice.
Yeah.
And he's like,
Well, you guys have always been talking about on your show.
I feel like just thinking about Succession, the opening sequence of the first episode, I was like, this show's for me. I'm hooked.
Well, you guys were promoting it. And I was like, well, maybe I should go back and watch it. And I thought too, I'm like, you guys also promoted Yellowstone. So I'm like, can I really believe it? Can I not believe it? But I've actually started over again.
Yeah.
And I'm kind of getting caught back up a bit because I know the new season came out. So.
Episode 1 of season 3 just came out. It will blow your hair back. I'm telling you, this just gets better and better.
Well, the timing is great because my Billions on Showtime, that just ended. So now I got to fill that gap there. So now I'm starting with Succession.
Okay. And you're more of a Billions Suits guy.
I'm a Billions. I'm a Suits. I'm like a Dragon's Den, Shark Tank, and then you can't judge me when I say this one, like the $1 Million Listing stuff. I watch all that stuff as well.
Really?
It's kind of tacky, but I watch it all. Yeah.
Just love real estate though.
That's what it is, right? And I love when you watch like the $1 Million Listing and they sit down for coffee and they just sit there and just negotiate a deal with no paperwork, no nothing, and they shake a hand and as if that's how the $20 million house is really selling here, as if that's really how it works.
Right on. Well, before we get to our talk with Matthew Dunnigan, we have one more thing. Of course, there's a sponsor. There's a sponsor.
By the boys at Impact. Matt, Al, John, the team, everyone over there with over 50 years of lending experience. And for all your commercial lending needs, regardless to the asset class, reach out to them at impactcommercial.ca.
Without further ado, let's talk to Matthew Dunnigan, commercial mortgage specialist. This is a great episode.
Enjoy, guys.
Okay, so we're here with Matthew Dunnigan, commercial mortgage specialist at Impact Commercial. How you doing, Matthew?
Doing fantastic. Thanks for having me, guys.
Great. Yeah, no, thanks so much for taking the time today. Maybe just to start, Matt, can you tell us a little bit about yourself, focusing specifically on your hockey career?
Yeah, definitely. I'll get into that. So I kind of grew up between kind of the East Coast, West Coast, say more, Ontario, Vancouver. Started my career in Toronto in banking and in commercial lending for about 3 years there. Moved back west to Vancouver, continued banking, for another 8 years. Spent some time in the Fraser Valley, moved downtown there for a few years. So pretty much all kind of banking background.
And what got you into the mortgage game?
Yeah, so funny enough, I kept running into to Alan Hegg, who's our managing partner at Impact. We actually played hockey together. Kind of ran into each other about 6-7 years ago. Played a bunch of hockey, and at the time I kind of kept on running into him as well in downtown Vancouver. I was at the bank at the time. He was with Impact. He ended up sending us a few deals, and we just kind of kept in touch and kept running into each other. So it's almost kind of that sign of fate. And he was growing the business at the time and adding a new broker or two. So continued chatting and ended up jumping over to his side of the world. And the rest is history.
Now, when you say playing hockey, Matt, were you coaching Al? Is that what you were doing? Because I'm guessing there's probably two different levels of hockey that was going on.
Unfortunately, I was playing. So depending who I was playing with, they would have either liked or hated it. So,
well, Matt, one reason why we want to have you on today, obviously we had Al on when we kicked this thing off, months and months ago now, it feels like. And he kind of gave us a broad strokes of how commercial lending works in various departments. We had John on from Impact there where he dove into owner-occupiers and how we can make tenants their own landlords. We've had a lot of requests from listeners that they want to know, I want to buy an investment property. I need to know more. How do I finance that in particular? So we wanted to have you on today and we can kind of break that down. And sort of there, maybe you want to just start off by just giving us kind of like the Coles Notes top line. Like, I want to buy an investment property. What are the first things I got to do? What are the first boxes I need to tick off before I can show up at Impact Commercial there with a deal for you?
Yeah, totally. Yeah, so great question. So for investment properties, obviously, us at Impact, we love to look at these deals. So whether it is owner occupied, investment property, construction financing, we love to look at these deals. In terms of just the investment property financing, how to really get into it. Vancouver, it's a tight market. So you want to, identify the property first. We can usually get up to around, 75% financing on the investment property type. Of course, you want to identify, what kind of property you want to look into. So, of course, with investment properties, you got your retail, your industrial, your office space. We'll include asset types like apartment buildings, multi-unit residential, even storage unit buildings. Obviously, you guys had a great podcast on, I think, a month or two ago on storage units, which was awesome. So the main thing or the risks when you're looking at investment property financing, we kind of want to break it down into two elements. So, first is, deciding on the value or determining the value of the building. So of course, looking at the due diligence there, getting the appraisal, seeking the financing. And then the other main driver is the lease agreement. So whereas the owner occupied kind of buildings, the risk is it's mainly on the financial strength of the business In the investment property world, the risk is solely on the lease agreement, between the tenant and the landlord. This lease agreement, it's going to drive the cash flow, which is basically the debt repayment to the bank. So really the lifeblood of the asset is the lease agreement. So, you'll have your 5-year lease agreement, your 2 times 5-year renewals, all that kind of stuff.
So can we unpack that a little bit for listeners there? So I'm Matt. I'm going to go buy a property here with my brother Adam. And we're looking around and we're not sure how much down do we need. We're not sure what we're looking for. For that first-time investor, key thing or key takeaways is we have to find a property that's tenanted, probably more so than something vacant. I'm guessing maybe that helps out and you can maybe, talk to that. But also, how do you determine the down payment requirements? Am I looking at 10%, 20%, 50%? Is that derived by the income of that lease?
Or the asset class? I'm kind of curious as well.
Yeah. We asked 6 questions here in one every time. So
I'll try to remember them all. No, it's perfect. So Cory, going to your stuff first, can we finance, an untenanted building? Well, so we can start to go to, certain types of lenders to look, we can go to look to alternative lenders, which will finance untenanted properties. So the whole idea is, if it's a new build, obviously new development, new build, need financing, can go in there, get some alternative lending, at least to close the deal or the purchase. And there, we give them kind of 2, 3, 4, 5 months, whatever it is, to find the appropriate tenant, get the market rates, set up the lease agreement, and even just refinance it with another lender. So yes, there is an option to finance untenanted buildings. Of course, most lenders, they want to secure the cash flow. They want tenants in there. They want a lease agreement set up. Again, that is the lifeblood of the cash flow for the bank. So in terms of the actual down payment, so, generally speaking, with investment properties, we usually like to see about a 25% down payment. Most lenders are comfortable with lending, kind of up to 75% loan to value. So that's kind of the general rule of thumb there. I think, Matt, in terms of, your question, in terms of like the different, asset types or classes, of course, lenders like some or, not to say they dislike others, but there's definitely some ones of priority. They love industrial. Industrial has been the way to go. Office, is coming back, which is nice. Retail, they'll still do, of course, but, obviously with, obvious reasons, it's kind of struggled a bit. So, multi-unit residential, love. Storage units love. So it's kind of that old adage. I think it's, beds and sheds, right? So, multi-unit residential and industrial. Lenders absolutely love.
So Matt, just thinking about interest rates here, if you're buying a place for your own business versus an investment property, is there a differential in interest rates for an investment property?
Yeah. So in terms of the interest rate, it'll really depend on the risk profile of the tenants. So yes, you may get higher interest rates depending, if the risk profile is a bit more increased. You might, get the benefit of some low interest, if you have, better quality tenants, a stronger lease agreement. I'll just kind of quickly go over the details of some of this stuff. So in terms of the lease agreement, the longer the lease term, more stability, you'll get a better rate. We'll talk about the quality of tenants. So obviously, the stronger the tenants, that a lender likes in terms of their business or their operations, the cheaper the rate. So, if you got some environmentally risky tenants, like a dry cleaner or like an auto body shop, something that's a little bit risky, if the lender's going to do the deal, they'll probably, guard against it with a bit of a higher rate. And then also things like, is it like an anchored versus unanchored properties? If you have a, Walmart or something that's next door that's driving in business, things like that. So if you got strong neighbors, that'll kind of draw into the building, that'll help. And then of course your tenant themselves, right? So if you have a national or investment grade, tenant versus like a mom and pop store, the quality of that actual tenant in your own building with all of those other aspects will definitely determine from the bank whether, the risk profile is low or it's high, and that'll kind of determine the interest rate.
And what is the range thinking about from, a stable, great tenant versus, the type of tenant that the lender is going to look unfavorably upon?
Yeah. So just like even in terms of like the range of interest rates offered?
Exactly. Yeah.
Yeah. So it's, like I said, it kind of, for something that's a really good industrial tilt up concrete strata unit, all the way to, a dilapidated building. And depending on the risk profile, we're still seeing anywhere from, the high twos from conventional lenders, all the way to, 8, 9, 10% to these alternative lenders. So there is a big range, of course, but it's all dependent on these kind of quality factors.
So William Wright Commercial shows up with the pinnacle of best properties you can potentially buy in an investment. We've got the AAA government tenant. We've got a cap rate way over what the market would typically yield. Is there a way as an investor that I can somehow get less than, say, the 25% benchmark down? Or regardless to that income, that's kind of the entry level that lenders are comfortable with. That way when buyers are looking, they know that that's kind of the numbers they got to work within.
Yeah, so it is the typical benchmark. Some lenders are moving upwards. So you can maybe argue against an maybe 85%. Most of it is guarded by the lease agreements.
Yeah.
Whereas kind of how, John was mentioning before, the owner-occupied stuff, like lenders like it when there's a bit of skin in the game, when your business is there, when you're, a quote-unquote owner-operator. And that's why banks were kind of comfortable with going up to these, 85, 90% loan-to-value levels. Like, there were years ago, they kind of only held the line at 75% for the owner-occupied. And now we've seen lenders go up to the 90%, over the last couple of years, right? So they're all kind of coming up together, right? So it may not be unusual to see the investment property world also come up a bit more. But like I said, it's because there's potential turnover in the tenants.
Yep.
And it's really, the risk is based off that lease agreement, which just could be a 5-year thing. That's kind of why they guard against kind of that loan-to-value mark.
So for the listeners there, 25% down is kind of the benchmark we're looking for. The longer that lease term is with the current tenant is going to help us in the lending. Is there markets that lenders are more favorable to than maybe not? If a client comes to you with a great retail investment property in Yaletown, strong tenant, 5-year lease term, is that a much more favorable market than that same tenant arguably being tenanting a property, say in Chilliwack? Are the lenders going to be more favorable to the larger cities, or are lenders now becoming much more open to looking at maybe some of these suburban markets and even as far as Chilliwack than maybe they were 5 years ago? I know, again, that's the 4-for-1 deal there with the question, but I'll let you take it from there.
Yeah, totally. So, of course, lenders love liquidity, right? So if you can get an asset class, close to a metropolitan city, the closer it is, the more liquid or easier it is to turn over, to sell to another investor. Yeah, so lenders would love, the closer you are to the epicenter, they love. When you start going out, obviously, to the suburbs or these other surrounding cities, there's going to be less turnover. But again, then you kind of get into the whole cap rate conversation. So you're going to appreciate, higher cap rates when you move out. Obviously the values come down a bit. Your income comes in on the other side, thereby increasing, your cap rate or your rate of return on that building. Downtown is, mostly dominated by the REIT. So the real estate investment trust. So, they'll come in, they'll acquire the building. They have, as much time as they need. They're not really concerned about, the cap rates. They're getting their 2-3%, but they're appreciating the value increase of that major downtown building. Whereas you're going out into these other areas, you're getting your increased cap rates. And most of our clients are, your regular investors. So, we always tell them to go to these outside, perimeter cities to actually enjoy the return.
So, Matt, we work on the residential side where if you're looking to purchase an investment property, it's a fairly extensive process, often going through your own personal finances and basically establishing that you have the wherewithal to carry it. Can we talk a little bit about the difference between how lenders are looking at commercial properties versus how they look at residential investment properties?
And Matt, before you answer that, I just want to clarify, when my Matt says we, he's referring to himself and Adam.
Yes, yeah. Yeah, exactly.
Yeah. I'm not part of the we.
Personally speaking, of course. The major difference is obviously, looking at the financials of the building. So let's call it the property operating statement or the financial statements of the building versus, your personal net worth. So, Matt, in your world, you're looking at the personal net worth statement, you're looking at the annual income. You're seeing if they qualify from, a debt servicing point of view. It's basically the same thing on the commercial side. We're looking at the financial statements or, the property operating statement of the building, just as, servicing or repayment of the loan. So, and that's kind of, why I keep saying it really goes back to the lease agreement, which is the driving force of everything. So, that's going to set out your how much you're getting per year. You're going to take your building expenses. You're going to see if you've covered everything, including, the blended payments of the loan. So yeah, everything on the commercial side really kind of goes back to that lease agreement.
Obviously, COVID's had a major impact on a lot of asset classes, and we touched base on that earlier from maybe retail's not as favorable as it once was. How much impact has COVID had on just the overall lending world? Has banks, has areas been sort of struck off that? Obviously, some asset classes are more favorable now than they maybe once were. What has COVID done to the lending world, and what are some new challenges or some new stuff you guys have had to implement when dealing with clients?
Yeah, no, great question. Something we've all kind of been experiencing over the last year and a half, 2 years now. So yeah, I can tell you, for the Cory, you can probably speak this as well, but in the brokerage world, it's kind of been a silver lining for brokerages for getting deals done and going, direct channels to lenders for actually getting the deals done. In terms of, the investment property landscape, industrial has been a huge, beneficial asset type during COVID. Like we've seen, some of the agents have been telling us, we've seen drastic market rate increases on the industrial side. I think it was out in Delta. I was looking at some rates from a lease agreement a few years ago that were kind of at $13, $14 square foot. And, had a call in the other day and it was, it's up to $19, $20. And that's just all in a matter of, a year or two. Industrial's always been strong. It's hard to find land to build new industrial asset types. So industrial's definitely benefited. Retail, of course, we all know about retail. It's, taking a bit of a hit. Obviously, less foot traffic, people going into stores, but, that is making, a comeback, of course. It's funny, with retail, there's almost been a shuffling of kind of retail that's gone from the downtown to the suburbs. And I almost look at a good example is actually what Starbucks kind of did right at the beginning of COVID, where they kind of took out, half of their downtown locations. And I'm speaking of Vancouver, but they took out half of their downtown locations and they've gone out to the suburbs, just because they're getting the driving, traffic within their own suburb. And, they knew there wasn't as much foot traffic at the downtown core at the time. So, some of the larger corporations have definitely, even benefited a little bit of this, even in the retail space. Multi-unit residential just is always fairly stable. Again, depending on how close you are to the metropolitan city, it's, that's an asset class that will always kind of stay strong. And that's obviously dependent on other economic factors. Storage, lockers, those businesses, those will, remain strong. They've been strong throughout COVID. And then of course, what am I missing here? Office. Yeah. So, again, office, we've seen some companies obviously kind of scale back, which is fine. This whole work from home aspect. But, we're definitely seeing a return to the office, larger, mid-sized, smaller corporations. There's been a lot of floors that have kind of been, stratified or broken down a bit. So, you're getting some smaller businesses that are looking to get out into the office world. So yeah, there's definitely been a lot of shuffling and change though. So some for good, some for not, but yeah.
Matt, maybe shifting back, and I'm just always curious about how to get the financing done. Top 3 reasons deals collapse in your world.
Oh yeah. Great question. Timing. A lot of it's just timing. It's a lot of it could be, a quick approaching subject removal date, a fast closing date. We benefit from, and I see, so we at Impact, our brokerage, we benefit from knowing, a ton of contacts, a ton of direct channels, a lot of the lenders. So whenever we get, deals in or guys call into us, we we're on it right away. We're calling all the direct lenders. We're trying to get ahead of the curve. We're, everybody's busy. So we try to get the appraisal ordered right away. We try to get the environmental reports, whether it's a stage 1 or phase 1, try to do all our due diligence and get all of the professionals basically on board, just so that we're not, our backs aren't up against the wall to this any kind of, fast approaching date. So in terms of, most of the clients that we deal with, we always like to confirm their equity right away. So in terms of, whether it's meeting the 10% for the owner occupied or the 25% for the investment property type, we like to confirm that right away so it's not an issue down the road. So I would say the biggest reason, why it may fall through is just initial timing. It's definitely a seller's market. Valuations are really high. People are trying to get a price they want. And, obviously there's a ton of bids going into each, transaction or kind of offer summary. So it really kind of comes down to timing.
Can we talk about that maybe a little bit too, about the due diligence material that you're going to require as part of this? And maybe what I'll do is I'll sort of run through it a little bit. And if maybe you can elaborate a little on it. So traditionally when someone's buying an investment property, and we'll take the assumption that this is, we say not a strata lot and it's a freestanding building, you're going to need an appraisal ordered, which is what the bank will use to look at the lending aspect of it. You're going to need an environmental report that you touched on, which is a phase 1 or even a phase 2, stage 1, stage 2, which is sort of going to confirm the soil, hopefully, lack of contamination in the property. Probably a building inspection report, because when you are buying a freestanding building, a roof, a mechanical problem, that is you. You're going to need a copy of the leases in the property. And one thing I think some people forget to ask for is when you're looking at a freestanding building that could be multi-tenanted, the leases are great, but you also want to get financial statements on that property, because operating these buildings isn't sometimes as easy as everybody anticipates. Matt, is there anything there I'm missing? Are those kind of the 5 sort of key things that you guys are going to need to work off of?
And confirmation of, I guess, the down payment.
A down payment, yeah. So he'll take that information.
Yeah.
They'll then come back and sort of comprise around there. And then Matt, is there anything there that I'm missing?
You got it. Yeah, that's pretty much it. That's kind of the list. All these professionals we try to engage right away, but you're pretty much bang on. Yeah, appraisal for the valuation, environmental for the clean soil, structural and mechanical report, like you're saying, like a building condition report. That definitely comes up. It doesn't come up in every single deal. Most lenders love, obviously want the appraisal. Some, depending on the age of the building. So if it's a new completion building or a newly constructed building, you probably don't need the environmental report. If it's a new business park that say went up, that developer does their due diligence initially to say, hey, we're going to build here. We're going to dig the soil, so we trust that they do their due diligence, and the lenders can kind of piggyback, their existing reports.
Yep.
When the issue is when you get into these really older buildings, anything can go wrong. And, if it's not the environmental that's an issue, it may be something about, the building itself, Cory, like you mentioned,
Yep.
you could have faulty electrical, the plumbing could be off, the roof needs repair, the envelope is starting to, fall apart a bit. So, that's, structural and mechanical report can be really, really, really important. And even taking it one step further, we can get, these depreciation reports as well, right? So, telling, how much work is going to be needed down the road, in 5, 10, 20, 30 years. This gives the lenders, a good line of sight. Are we comfortable with financing this property? Is the client going to need extra liquidity down the road to take care of these, repairs and, one-time repairs that are coming up in, 5, 10 years? So all these reports, obviously there's a cost to them, but very, very important to the lenders, to us, just to make sure that we have a sound investment deal.
Matt, so all of those reports are kind of this second stage. I'm wondering, taking kind of the moving back to maybe before somebody puts a deal in front of you. And now obviously they'd be working with somebody like Cory who can kind of walk them through the process. But in terms of numbers, just when a deal makes sense, like a back of the napkin type numbers that you're working with when something comes across your desk, like in terms of cap rates, when does a deal make sense? When are you like, these numbers are, this isn't going to work?
Totally. Yeah. So just kind of a quick way to look at it, even just going back to the lease agreement. So, taking your lease agreement, looking at, the base rent, multiplying that by the size of the building, the square footage, you kind of get your annual cash flow. And then just taking your kind of debt amount. So again, buildings, let's use an example, $1 million of the purchase price, generally speaking, lenders will look at, 75% financing. And so you kind of do the repayment on that. And, at the end of the day, see if your annual cash flow in the building is enough to service. So it's, that's kind of the back of the napkin. And again, your inflows obviously really are just determined on the lease agreement. And then the other aspect, obviously the outflow is just the loan itself. So, that will kind of set the stage for the cash flow side of things. And then the other kind of initial point that I mentioned before is really just the value of the building. So does it make sense, that this building is, being purchased for $1 million? Is it worth $1 million? Mm-hmm. So again, going back to the kind of the appraisal to determine that. So, yeah.
And are you seeing, in the residential world, often people are, at least in the initial years, kind of topping up? The property basically is not carrying itself. Is that ever the case in the commercial world?
I would say less likely, just because generally speaking, commercial values are a lot more stable than residential values, especially in Vancouver. In Vancouver, we see residential real estate values will ebb and flow quite extremely. So in the commercial space, you kind of get this gradual step up. So because of that, we never really have to experience any, top up financing, to help clients out. Because the asset values or the valuation of these, industrial buildings or, investment type buildings have just gradually been going up, our clients are experiencing just great appreciation of value. And, at the same time, their mortgage is still the same what they got it for a year ago. And, it's being paid down. So it's, obviously, we don't want to talk about the other side of the coin where, values start, say dropping, but, is that a potential? Well, yeah, sure. Right. Just like the residential market as well. So, we've been fortunate to have a extremely strong real estate market in Vancouver. We've been on a nice bull run, and I think we'll continue to be on one for the next, kind of 20 years.
Well, yeah. That leads me to my next question. I was gonna ask you to take out your crystal ball and say, what do you predict? So we have a 20-year runway ahead of us now.
Yeah.
One thing I think a lot of people, I know we look at it from the brokerage side of things, is you guys are getting deals from everybody and anybody, both local and foreign and all over the province. You guys can kind of start to put together, charts of where people are going, what cap rates are penciling out, is areas seeing increased cap rates, lower cap rates. With all that inside knowledge that you guys have, where's Matt Dunnigan buying?
Oh, geez. Yeah. Now the pressure's on. So obviously kind of staying, I would never be able to afford anything kind of like downtownish with just myself. But, obviously, speaking of, downtown metropolitan Vancouver, obviously, like I mentioned, cap rates are low, 2-3%. Our general clients and where I would go would just, go over to the island, go to Victoria, go to Nanaimo, go to Campbell River, go, out into the Fraser Valley. So, Surrey, Abbotsford, go to Mitchell, Chilliwack. We love the interior. Go to Kelowna, go to Kamloops. In all of these places, you're getting, your 5, 6, 7% cap rate. And, kind of like I mentioned, the further you go up from the epicenter, right, the values of the buildings drop. So, yep. They drop in comparison to the market rent. So the market rents, obviously they go down too, but not at the rate of the value of the building.
Yeah.
Kind of thereby increases your cap rate, right? So for any of us that are looking, whether it's yourself or a partner or a group of 3 or 4, it's like, go out to these higher cap rates where you can afford to get your 75% loan, or you have, your 25% down payment on this cheaper asset. You're getting a great cap rate, you're getting a great return, and you're getting out to these growing markets. Like, Vancouver's been a force and a driving engine to, BC's economy, right? And we're getting this like spillover effect to, Kelowna, and now it's being spilled over to Kamloops, and, Vernon is getting a lift, and all these kind of northern cities. So it's quite impressive to see. But yeah, I would definitely go out to, I know I named a lot of spots, but go to Victoria, go to Kelowna, go to these great, stable economies, and with better cap rates.
Well, I think one thing a lot of people don't, may or may not understand, we've talked about this before on the show, is the lease rates sometimes aren't a lot lower when you go out to these markets as you would find in, say, the Vancouver market, where sometimes people assume that if a lease rate in Vancouver is $45 a foot in a certain block, well, if I go to Victoria, it's going to be 20. And when you go to these areas and you go into the centers of these areas, the lease rates in a lot of the asset classes, it's very similar to what you'd find over here. You go to Victoria, you can spend $70 to $80 a foot on a retail space. Yet you can go to Yaletown and find some pockets in Yaletown at $55 a foot. So there's not a lot of, the lease rates in a lot of these markets aren't dramatically lower than what you find over here. But like to your point there, Matt, is the value of these buildings, you can get greater cash flow. And I know one thing we've always talked about here is we love Victoria, we love Kelowna, Kamloops, all these markets, because you're getting into a marketplace where you're not really sacrificing a lot on the vacancy rates to get a lot more upside, where you do have still that ability for these lease rates to grow in certain markets, and you're already getting a much better cap rate. My money doesn't care where it goes. Send it out, bring it home, and if it can bring home more soldiers with it, even better. So if I can go to Victoria and get a 4.5 or a 5.5 cap rate on a product, that same product might yield me a 2.5 or 3 over here, I'll gladly go over there, because my vacancy rates in some asset classes aren't terribly different than what you see here in the mainland street.
Just thinking this through, what's the case for downtown Vancouver? I mean, obviously stability and potential capital appreciation, I guess.
Yeah.
Is that the logic of not going outside of?
To Matt's point earlier, he said that a lot of people, when they're buying into these, these hub cities, they're buying for like an equity play, not so much a cash flow play. Mm-hmm. And what we've seen happen over the past few years is a lot of these large institutional buyers and funds and all of that stuff, REITs, like Matt had mentioned, they're acquiring more in Victoria now than they've ever done. They're acquiring more in Kelowna now than they've ever done, because they're watching these trends and they're saying, well, if I can, from a multifamily standpoint, if I could, I've got maybe a 5.5 cap, believe it or not, 3 or 4 years ago in Victoria, with probably a sub 2% vacancy in that asset class, or I can get that same product in Vancouver with a sub 2% vacancy for a 2.5. Well, geez, I'll go buy in Victoria.
Mm-hmm. Mm-hmm.
And that's what you're seeing. And I think one thing that COVID's really highlighted is a lot of people are moving into these marketplaces, maybe that once they didn't before because of work. They now can go to Victoria, where companies are coming over to the island to create jobs there, that maybe those jobs maybe would have been created 3 years ago. So there's more demand for the product. And what happens is people move and migrate into these markets, then demand for retail and office and all that stuff kicks in as jobs increase. Mm-hmm. So, I'm, to Matt's point there, I obviously we talk all the time about it. And then Mr. Dunnigan there, you don't realize this, but, you will at some point, because the application will probably end up on your desk, is Matt and Adam over here. I convinced them to buy a commercial property for the first time ever with me in Victoria. Nice. And you're not the first guest that's come on and said, well, I'd buy in Victoria. And every time someone says that, I look across at Matt, and Matt is just doing the dollar signs in the air, backing up the dump truck, shooting the money guns. He's just like, yeah, everyone says we're in the right market.
You should see my money guns.
So Matt, before we wrap up there, we have our 6-pack of questions, so we get to know you a little bit more outside of the office here. Do you have just a couple more minutes to hang out with us?
Oh, I love it. I look forward to this. Definitely.
All right. So our 6-pack is powered by our good friends over at Red Point Law. For all your commercial legal needs, please visit them at redpointlaw.ca. So first question up, favorite vacation spot when you find the time?
Oh, geez. You can't argue with, Maui is obviously a fan favorite. Nice. Maui, I've been going to Florida last couple of years, though, just kind of south of Daytona Beach. So I kind of love that part of the East Coast.
Wow.
Interesting.
Yeah.
You don't hear, I guess.
Well, you haven't seen Matt. Okay. This guy's like a 6'4", built like a goddess with muscles. Like if I was him, I'd be going to the beaches down south too. But unfortunately, my pear-shaped body with sagging parts isn't really.
You look good in Miami.
Yeah. Maybe at the senior home, I would. Maybe at the senior home.
So Matt, second question for you: favorite band or song? And this is the one that really you're judged by in the end. So,
you know what? Just from listening to past podcasts. I was really gonna say Nickelback. I know Cory's been all over that. I've been listening to a lot of Mumford and Sons. Like I love Mumford.
It's not a bad one at all.
Good energy, really good song. So actually, I saw them a couple years ago. They opened up for U2, I think, like 3 or 4 years ago at BC Place, and I was very impressed with their performance. So yeah.
Well, it's funny. The last guest we had on, a gentleman named Peter, his favorite show was Suits. So that's my favorite TV show. And I thought if Peter said Nickelback, I was on the next plane to Hong Kong. I'd found a bromance to flourish. But all right, next question up for you. A book you'd recommend our listeners, and it doesn't necessarily have to be real estate related.
Totally. What's funny, my dad gave me this book a bunch of years ago and just read it again. But it's called Who Moved My Cheese by Spencer Johnson.
Interesting.
Yeah. What's the? Can you give us a synopsis?
Yeah, it's kind of about, not to fear what kind of lies ahead of you, but you kind of live in the moment and, thrive in the environment of change and uncertainty. So it's almost kind of like the power of now kind of thing. So yeah.
My Matt over here is a little worried you're talking about moving his food. So
explain the cheese component.
It wasn't the word burger
we all
to
love
follow.
Cheese, right? So
favorite movie?
Oh, you know what? Yeah, I was thinking about this. I love the movie Lord of War with Nick Cage. It's got to be one of his best movies. He's done a lot of movies. But
I don't think I know the movie. I don't think I've actually seen that movie.
It's such a good movie. He's basically an international gun runner or like an arms broker. Very good movie. Yeah, it's got Ethan Hawke in it. Nick Cage has done some very terrible movies, but
he's also really it's hard not to love Nick Cage.
Yeah, Face Off there with John Travolta. Yeah. All right, Matt, a quote that inspires you or a quote that you choose to live by?
Yeah, I love this one. It's happiness is only real when it's shared. And this is actually from another good movie that I like called Into the Wild, where I believe it's Emil Hirsch kind of gives up all his possessions, goes up to Alaska, lives in a van or lives in a bus. And
right. I think this is based on a true story, right?
It is. Yeah. So he, gives up all his possessions and then he realizes he's not so happy because he's alone in the wilderness. Yeah.
Sounds like your high school days there, Matt.
Alone in the wilderness.
Yeah, but Matt was alone in the hallway.
My memoir. Last question for you, Matt. One piece of advice for listeners looking to get into the commercial real estate investing world.
Oh, yeah. To save your, save your hard-earned money and your pennies, as early as you can, and try to get that. that down payment, right? Whether it's 10% or 25%, right? There's no late time to get into the market, right? It's, people think Vancouver's expensive. Well, I'll tell you, it's going to get a lot more expensive. So, there's no time like the present, right? So, get a partner, get a few friends, scrape up some investment funds and just, jump into something. So, yeah.
Before we go here and we ask you how we can get a hold of you, let's elaborate on this hockey career. So I mean, we have an annual William Wright commercial Whistler retreat. We take all the offices up for a weekend of golfing and sort of celebrating everyone's year that was. And we had all the guys from Impact up this year with us. And rumors flying around Whistler where this tall 6'3" or 4" goddess guy walking around the pool table having a drink was a hockey star. So can we elaborate a little bit on that?
Are you sure that wasn't Matt Everett and not myself? Or
I've seen Matt Everett try to attempt to skate, so no, it wasn't him. It wasn't him.
Yeah, no. How they can get a hold of me is you can Google impactcommercial.ca. I'm on LinkedIn as well, so you can search Matt Dunnigan with 2 N's. Yeah, or I'll leave my direct line is 778-847-9707. So yeah, either way is totally fine.
And then are you offering skating lessons at that same phone number?
Yeah, if definitely for family and friends. That's about all I have time for right now. So, but yes, yeah, definitely.
Well, thank you so Matt for joining us. We really appreciate you taking the time of the day. We know you guys are busy and obviously
that was great.
We have nothing but amazing things to say about all you guys over there at Impact Commercial and everything you do for clients, not just with us, but just in the community, the brokerage community as well. So we're very thankful for all that.
Yeah, no, and you guys are amazing. Keep doing what you're doing. I listen to your podcasts all the time, and you guys are awesome. So thank you very much for having me. So.
Thanks so much, Matt.
Okay,
Take care.
Thanks, guys.
Take care.
Okay.
Bye-bye. And there you have it, folks. Our interview with Matthew Dunnigan, Impact Commercial. But before we go too far, Matt, did you hit record?
Yeah,
you know what?
This is our first crack at the outro, and I feel like it's going well.
Okay.
First of all, we're recording. Yeah, that's real positive. Yeah, that was a great conversation, and it's worth repeating the difference between the residential and commercial space when it comes to financing. The more I learn about this commercial stuff, the more excited I get. Well,
as we alluded to on the episode there, it seems like every guest that comes on and we ask everyone, hey, where are you putting your money? Everybody says, Victoria, you're 1 for 1 in your commercial investments. You're 100%. You're batting 1,000 right now. You're batting 1,000.
I just surround myself with good people.
I wish I could say the same. Great episode. One thing too, he sort of just gives us all that baseline information of what you need to know. He talks about the highlights. One thing he didn't talk about that I should have probably preference on the show is one question we get, that if someone gets a really good buy out there, and let's say, for example, the appraisal, it comes in at 1.5 and they're paying 1.3, does that change the loan to value or the down payment requirements? The bank will lend on the lower of the two, the appraisal value or the contract. So even if you get a contract done at 1.3, but it appraises at 1.5, that loan to value ratio, which determines your down payment, is done off the lower of the two. So in that case, it would be your contract. And that's one thing that we have, where clients have got really good buys, or maybe they have a little bit longer closings and the value is appreciated. The bank's still going to hedge their bet and take the lower of the two.
You don't benefit from that?
No, not right away. But what you do is you close on the property, let the market work its magic, and then a year later you can go back and you can refinance it. And that's, Al and Matt and John and those guys will take care of that for you as well.
Fantastic. Well, maybe we'll leave it there. One thing before we go, Cory, of course, all the Vancouver Commercial Real Estate Podcasts live over at VancouverRealEstatePodcast.com. Head over to VancouverRealEstatePodcast.com for all things real estate related. Here, basically in the province of British Columbia, I feel like it's almost a misnomer now, just focusing on Vancouver. But you can get transcripts of these episodes. We also have VIP commercial and residential pre-sale projects. And if people want to find out more about what you're doing over at William Wright, Cory,
they can visit us at williamwright.ca. They're welcome to call our Vancouver office anytime, 604-428-5255. And they're always welcome to send me an email at cory@williamwright.ca.
Fantastic. Well, have a great week, everyone, and we'll be back next week.
Thanks for listening.
Subscribe today.